Invite our Alpha Manager of the Day. Karthik Kumar is a fund manager at Axis Mutual Fund. He's joining us. Karthik, good to have you with us here. Thanks very much for your time. Just a quick word. I know, mutual fund managers are usually talk about the longer term, and that's the right thing. But since we're experiencing a pretty large move today, some 300 points off the low, what's the market suddenly building in, Karthik, into your mind? I'm sure you're following markets, and what's getting priced in? Are we getting into a new high and then up and up kind of a phase? What's your sense?
I think the market's pretty much been quite choppy since the turn of the year, and it's been range bound. I kind of expect that to continue for some time, given uncertainty with regards to politics, uncertainty with regards to monetary policies, especially globally as well. So I think we are just in that phase where we are range bound, and I wouldn't read too much into these daily moves one way or the other. But having said that, it does present us with good opportunities at a stock level. Having said that, while our markets have been kind of range bound, we've still have managed to outperform the emerging markets over the first quarter this year. And we are still one of the better performers across the region and backed by good growth expectations over the next 2 years. So from a fundamental perspective, most things seem solid. And I wouldn't read, as I said previously, I wouldn't read too much into daily moves. It's just been range bound over the last quarter or so.
Karthik, hi, good afternoon. So I want to straight away draw you into the debate and discussion that we've been having on the channel since yesterday on, RBI's actions and how different entities are sort of coping with it. Our colleague Ritu was just talking about it. I was looking at your fact sheet, the March fact sheet, and it's pretty evident, right? For any domestic fund, it's a little difficult to exist without having a large allocation to financial services. And in a lot of your schemes as well, the blue chip fund, I think you're at 30%, is the highest allocation. The ELSS fund is at 25%. And I think even the focus fund, some of the other schemes as well, you're at 27, 28%, depending on which fund we're picking up. So how do you, as a manager, how do you navigate these issues when RBI's actions could be leading to casualties which are big in size? 10, 11% gone from a Kotak. There could be Bajaj Finance, there could be a different NBFC, it could be a Bank of Baroda. It's pretty much happening across the board now. So how do you navigate this? And more importantly, does it kind of create a slightly longer overhang above the entire sector?
In terms of your latter part of the question, in terms of an overhang for the sector, I think that remains to be seen. That's definitely a possibility, but we'll have to evaluate as data comes through. With regards to positioning itself, with the fund that I manage, which is strictly quantitative in nature, as you rightly pointed out, given the large allocation of financial services to within the benchmark, it's very difficult to avoid the sector as a whole and the big names in particular. But what we can do from a risk perspective is look at the positioning within that and be allocated accordingly. For instance, within quant, within the quant fund, what we are underway. We are underweight financials, and within that, I'm underweight large private banks particularly. And actually, the financial exposure is well distributed across public and private banks, some NBFCs, and also capital market beneficiaries. So kind of diversified within the financial space. And I think that's the best way to play it, which is look at it more from a risk perspective as well.
All right. Hi, Karthik. Good afternoon. Good to see you, Wayne. So incremental money from here will go to PSU or to the private banks?
So I think it's, as I said, it's well diversified. Aside from PSUs and private banks, you also have capital marketplace that continue to look attractive. Plus, there are other sectors that I continue to remain bullish on, which is select consumer discretionary plays, largely through autos. And there are utility names as well, where I continue to remain overweight. So the incremental money would go in depending on how the earnings season pans out and how the incremental data comes through. But essentially, from a style perspective, from a quantitative framework perspective, what I think is going forward, the markets will continue to reward growth momentum kind of companies. And in that context, the earning season becomes more important because companies that justify or reinforce their growth prospects through good earnings will kind of be rewarded. And the same goes with companies that fail to meet expectations where the price reactions can be quite sharp as well.
Okay, just hang on, Karthik. Since we are on the subject of banks and financials, let's just look at Axis Bank once again. We'll come back to you for more questions. But Axis Bank has really delighted the street. Stock's been up 5-6%. Yeah, a little over 6% right now on what's been a dream run in the fourth quarter. They've beaten, the street on most parameters. Margins have expanded in a tough environment. Abhishek's joining. And Abhishek, what has worked for the bank and what's the view on the street?
Beautiful quarter. Q4 FY24 has been superb for them with respect to various parameters. If you take a look, records galore over there. Gross NP ratio is the lowest in last 34 quarters. Net NP ratio is the lowest in last 35 quarters. Now, net interest margin for the industry as a whole has been on a declining trend. Analysts were pegging an 8 to 10 basis point decline in net interest margin. However, the global net interest margin has expanded 5 basis point sequentially, thanks to the fact that domestic net interest margin has expanded by about 8 basis points. So return ratios are at the strongest point that you are seeing in last 9 years. ROA at about 2%, ROE of more than 20%. The annualized slippage ratio is one of the lowest in last 14 quarters, coming in at 1.44%. Analysts were pegging that slippages will increase on a sequential basis. However, slippages have declined on a sequential basis. CASA ratio has improved for them for the first time in last 4 quarters. And with reference to the PNL, both the NI and PAT is ahead of our poll. PAT also has a factor that other income grew robustly this time around. Back to you.
Okay. All right, Abhishek, got that. Thank you very much for the same. Karthik, just to come back to the point you were making on consumption, what is your current stance on the sector? And I'm talking more about staples because that's, again, that's largely been an underweight to neutral for a lot of money managers on the street for very obvious reasons that we know. Are you expecting a turnaround and what's your current thought process over there?
So as you pointed out, I have a similar stance as well, where I'm slightly underweight consumer staples. And the catch there is the earnings growth visibility still remains quite limited. The companies that have reported so far have not reported numbers that would kind of challenge that assumption or the street assumption as well in terms of expected growth rate or earnings growth rate. So I think there are opportunities elsewhere across the market where the growth visibility looks much better. And so I think the stance is unlikely to change, at least from my end in the near term, because even from a valuation standpoint, they are expensive. While growth seems tepid in the near term. So I don't see the positioning changing anytime soon.
Your thoughts on the telecom space, Karthik? In the quant framework that you work, is that sort of coming up, throwing up ideas there? What's the view?
It's a quite a limited space in terms of just the number of names. But as telecom, we as a sector, I'm quite neutral to that sector with reasonable allocation to names that are available in that space. But the fundamentals and earnings growth visibility and growth expectations are looking much better, and valuations there is still reasonable. So it's an area that looks attractive from a quant framework perspective. But as I said, there are only so many opportunities there within that space.
So what's sort of flashing as a complete overweight for you right now?
So as I said, I still continue to remain overweight healthcare pharma names, largely driven by pharma names, and a couple of hospital names, but largely dominated by pharma. Then within consumer, it's largely a mix of autos and auto ancillaries across two-wheelers and four-wheelers. And then I still continue to remain overweight the power utility names. So those are the three overweight themes that have been consistently overweight. And on the underweight side, as I said, financials, I continue to remain underweight the large private banks. I'm also underweight the commodity plays. While they have rallied over the last month or so, which has been a bit of a pain, but I still continue to remain underweight that space.
Okay. All right. Got that, Karthik. Thank you very much for your time today. Good talking to you, and we look forward to more conversations in the future as well. So that's a view coming in from Axis Mutual Fund. Okay, we're rounding up at just close to 3 o'clock. Let's just check the screen once again. Not much has changed. Still a very solid 180 point.